All right. Well, thank you, Brad. Good afternoon from foggy New York City, and thank you for attending our annual Outlook Speaker Series. I think this one will be quite exciting and obviously very topical. Again, as Brad indicated, my name is Jared Carmel. I'm one of the managing partners and one of the founders of Manhattan Venture Partners. As you're aware, for Outlook 2018, we have assembled some of the foremost thought leaders and entrepreneurs around blockchain, cryptocurrency, and their future applications. If you follow Bitcoin closely, I'm pretty sure today's run was in anticipation of this webinar, but that's just a thought. So with that said, let me start by introducing Manhattan Venture Partners. As most of you know, we're a research-driven merchant bank that's focused on the secondary market for private late-stage technology companies. The partners of MVP are pioneers in the space. We've been integral in the institutionalization of the secondary market. While most others were trying to democratize the space, we've spent years institutionalizing it. MVP differentiates itself through a unique research and ability to streamline the transaction process by providing a one-stop principal investing and advisory solution to private companies and their varying shareholders. Through the MVP All-Star Fund, the MVP Opportunity Fund, and our wholly owned broker-dealer called Venture Securities, we identify opportunities, we target companies that are well capitalized by top VCs, have tremendous growth rates, and have a lower risk on the underlying business, technology, and ability to execute on a defined strategy. We manage all aspects of a transaction by facilitating communication with the buyer, seller, counsel, and company. Therefore, we can ensure an efficient, transparent, and issuer-friendly, and most importantly, U.S. regulatory compliant transaction. The team at Manhattan Venture Research, led by Santosh was the first to produce sell-side style research on private technology companies, starting with the likes of Facebook, Twitter, and LinkedIn. MVR provides insight for investors in the form of unbiased and cutting-edge private company research reports. The reports tend to have the ability of alleviating the opacity and informational asymmetry that comes with the asset class. The reports that MVR produce are akin to what the bulge bracket banks would initiate on public companies, such as an Apple or a Google, except our coverage universe is exclusively private. We were the first to initiate coverage on Spotify, Palantir, Snap, Uber, Airbnb, Square, Alibaba, and much more. So with that being said, and without further ado, I'm going to take a moment and introduce everyone to our panelists. First, we have Balaji Srinivasan. He is the CEO of Earn.com. He's a board partner at Andreessen Horowitz. Prior to taking the CEO role at Earn, Dr. Srinivasan was a general partner at Andreessen. Before joining Andreessen, he was the co-founder and CTO of Founders Fund-Backed Counsel, where he won the Wall Street Journal Innovation Award for Medicine and was named to the MIT TR35. Dr. Srinivasan holds a BS, MS, and PhD in electrical engineering. He has an MS in chemical engineering from Stanford University. He also teaches the occasional class at Stanford, including an online class in 2013, where he reached over 250,000 students worldwide. Next on our panel, we have Martin Hutchinson. Martin is an investment banker with more than 25 years experience. He has worked both on Wall Street and Fleet Street and is a leading expert on the international financial markets. It was Hutchinson's work in Bulgaria, Croatia, and Macedonia that solidified his reputation as a hands-on expert on developing economies. As the U.S. Treasury advisor to Croatia in 1996, he helped the country establish its T-bill program, launch its first government bond issue, and start a forward currency market. Hutchinson's return to the U.S. was named business and economics editor at the United Press International and was able to jumpstart the financial news operation of that historic wire service. Since then, Martin has written a number of economic and financial outlets, including Reuters, as well as editing investment newsletters, including one recently on cryptocurrency. In October of 2000, he began working and writing The Bear's Lair, a weekly investment column that now appears on the True Blue Will Never Stain website. Hutchinson earned his undergraduate degree in mathematics from Cambridge University and an MBA from Harvard University. Up next, as far as our panelists go, is David Søntebø. He's a serial entrepreneur with a passion for any kind of technology that can push human progress forward. He is heavily involved in the Internet of Things, distributed ledger, blockchain, entangled technologies, as well as smart cities, digital identity, e-governance, in innovative hardware design. He also happens to be the founder of IOTA. And now, without further ado, let me introduce you to our moderator, Santosh Rao. Santosh is a partner at MVP, and he's the head of research. He has 18 years of experience in technology, telecom, and equity research. Before joining MVP, Santosh was senior equity analyst and managing director at Greencrest Capital. Santosh was a rated analyst at other places such as Prudential, Payne Weber, as well as Evercore. Santosh has an economics degree from Rutgers University and received an MBA in finance from Rutgers Business School as well. As you probably know, Santosh is frequently cited in financial journals, and he regularly appears on business networks, including CNBC, BNN, as well as Reuters. So with all that being said, I'd like to pass the mic to Santosh to moderate the rest of the call from here.
Thank you, Jared. Good afternoon to all. Welcome to the webinar. I'm Santosh Rao, like Jared said, the head of research here at Manhattan Venture Partners. Before we go to the speakers, I just want to briefly set the stage today. It's an absolute honor to have the three speakers today. In Balaji, Martin, and David, I think we have the absolute thought leaders in this emerging asset class, a revolution, some might say. So, like I said, it's an absolute honor to have them. The order of the speakers today is deliberate. We'll start off with Balaji, get the overview of blockchain and Bitcoins. I mean, he's been a pioneer in that, an early adopter and a biggest evangelist, a great bull in this space. Then we'll go to Martin, who comes from a traditional economics point of view. He's been in various positions, like Jared just mentioned, so he can give us a good perspective and lead us into what we have today. And David, of course, will give us the other next generation ledger, IOTA, which is expected to kind of disrupt this whole distributed ledger space. So we'll see his take on that. One more point before I send it to the speakers, please send in your questions as they speak so we can try to get to them at the end of it. So with that, let me kick it off. I'll give it to Balaji.
Great. And
okay.
Balaji, are you in?
Yes, I'm in. I'm here.
All right,
yep.
Very good. Thank you.
Go ahead, Balaji.
Okay, great. So let me get started. So hi, everybody. Hopefully you've got the slides that I sent over in front of you.
Yep.
Thank you for that introduction by Santosh. So want to quickly just go through why I believe blockchain is important. I think that price, is ahead of progress now. I'd say a year ago, it was arguably behind progress. The trading of it is not something that I'm going to speak to as much, but I want to speak to what I think of as the secular through line, which will say that in 5 or 10 years, even a few $100 billion, I think will undervalue the extent of how valuable this thing is going to be. So, okay, so first slide, why is blockchain important? It transforms the way internet services are bootstrapped, engineered, secured, monetized, and financed. Okay, so second slide, blockchain transforms the way internet services are bootstrapped. Before, what you might do is gradually build a two-sided marketplace, social network, or messaging app, try to build a community. But one of the problems is all of these network effects, defending them has been, or building them in the first place is hard, defending them is easy. Now what you can do with this as a startup is you can airdrop coins and tokens to incentivize users to be early adopters. So you can give them value as essentially token holders, independent of the current value of the network. So you can basically materialize some portion of the theoretical future value of the network into the present and actually give that to people as cash with some upside. So that will completely transform the way that you launch a new service. It's basically as if you could take some of your cap table and actually split it with your users. The blockchain makes that possible because it turns your centralized Excel cap table into something which is programmatic that millions of people can now have a slice of. So I think that's a very big deal. Okay, number one. Third slide, blockchain transforms the way internet services are engineered. So this is an obvious point perhaps, but before blockchain, we have these, and these will continue, by the way, fully centralized, cloud-based, remote data, assumption of trust services, where you've just got all your mail at Gmail, all your data, on Dropbox, etc. Afterwards, I think a lot of services are going to be fully or partially decentralized. Full decentralization is challenging. By grid-based, what I refer to is not the dedicated servers in the cloud, but the network of part-time weekend warriors, the phones, the laptops, etc. local data, meaning, what it sounds like, and no assumption of trust. So a frequent kind of thing once homomorphic computation or homomorphic encryption rather becomes more feasible, or potentially things like secure multi-party computation, which are feasible even if fully homomorphic encryption is not, is to have your private keys locally and to operate on cloud data in an encrypted way so the cloud provider does not know, what data it's working with. So that's going to transform the way internet services are engineered for basically a lower trust, more local paradigm. In some ways, a return of desktop apps. Okay. Next slide. Blockchain transforms the way internet services are secured. So before, a good question people might ask is, why would someone hack me? I'm nobody, I'm not, Hillary Clinton or Trump. I'm not somebody whose emails are important. Why would they care about my email to, my dad or whatever, right? And so that's why people will just trust and use remote cloud services. Afterwards, with the blockchain, in 5 or 10 years, everyone is going to have some private keys locally on their computer. So why would someone hack you? They want to rob you. Okay, that gives an incentive, and it productizes effectively a compromise. Before, to take over a computer, if you hacked it, you had to monetize it. To monetize it, you'd run a spam ring, or you'd rent it out as a DDoS kind of machine. Now you don't need to do any of that. You would just take the private keys, take the money. So it's going to radically raise the threshold for what computer security is. It's going to push the design of fully secure languages and type checking and a lot of different things like that. The next slide, blockchain transforms the way internet services are monetized. So before, you monetize them with credit cards, ads, and really a banking system separate from the normal internet. Afterwards, you'd have micropayments, tasks, packet-based and fully programmable money. So, what do I mean by that? Basically, it is now possible because you can do small packet-based payment or very large packet-based payment. You don't need to use the traditional rails, and you can actually integrate payment into every click, into every upload and download, basically baking it in, just like you can like and tweet and poke at each other, you should be able to pay each other. And those are going to be literally packets that are initiated upon a click. So that's going to be a big thing. Then finally, just in terms of these 5 points, blockchain transforms the way internet services are financed. Before, you had angel VC, crowdfunding, in-person meetings with investors, going up and down Sand Hill Road and Wall Street. And afterwards, it's going to be ICOs, tokenization, exchanges, fully online crowdfunding, and basically, the decline of both really Sand Hill Road and Wall Street as kingmakers to the same extent they are. Ethereum didn't have anybody from really Sand Hill Road, at least invest in institutional level, and they're the second decentralized decacorn. And this is related to the decentralization of technology outside of Silicon Valley in general. Everyone asks, where's the next Silicon Valley? It's actually going to be in the cloud, because Bitcoin, Ethereum, and Ripple and so on are the first decentralized decacorns that aren't necessarily Silicon Valley headquartered. At least Bitcoin and Ethereum aren't. Okay, so now let's just go through some concrete examples. If you go to the next slide. Here's a few different areas where, just to give you a sense of how many different verticals the blockchain is attacking. So with social networking, earn.com is like a LinkedIn competitor. You can read more about us at earn.com and whitepaper.earn.com and news.earn.com. But essentially, it's a LinkedIn where you actually get paid for being on there, a professional network where you actually get paid, which makes sense. International wires, precious metals, P2P payments. We've got existing chains that are already making a dent in those. With messaging, you have Telegram doing its ton ICO as a competitor to Facebook Messenger and WhatsApp. With equity crowdfunding, AngelList has a spin-out called CoinList, which is actually doing online crowdfunding via so-called SAFTs for new tokens. If you go to the next slide, there's the things I just mentioned are really just the beginning. If you look at collectibles, CryptoKitties is kind of a version of collectibles on the blockchain. It's an ERC 7021 standard, which allows for the trading of non-fungible assets as opposed to fungible assets. So that's to say, it's a distinction between a baseball card or a piece of real estate versus a bar of gold. And so CryptoKitties, with collectibles, it's kind of, the offline equivalent would be maybe Magic the Gathering cards. With identity, you have something like Uport, which is logging in with the blockchain, as opposed to like a centralized Facebook login. Your private keys locally would provide your login credentials. With distributed databases, so things like Wikipedia, things like Google Maps, competitors will arise to them. There's already one that's arising vis-a-vis Wikipedia. There will be things like a blockchain-powered version of OpenStreetMaps, where you can get the crowd to build distributed databases and incentivize them to do so. And you've also got other kinds of things. So marketplaces, I already mentioned that you can bootstrap them. Things like OpenBazaar, CryptoCribs, they're going to be issuing tokens to pull people in. With DNS, the centralized domain name system, where you have example.com or google.com, there's now decentralized domain name systems that are arising. The Ethereum name system is already in production, and you can get facebook.eth or what have you, and now you can route payments and other kinds of things, and it can't be taken down. It can't be no platformed in the way that a .com can be. Browsers, Brave, MetaMask just hit 1 million downloads, so that's going to be something where Chrome is going to have to respond to that and build Ethereum and blockchain features into Chrome at some point. And then long term, I think decentralized cloud. However, I want to qualify this because I don't think it's going to be a direct competitor to Amazon anytime soon, but it will serve the kinds of needs that Amazon can't. For example, things like file sharing or BitTorrent or, Sci-Hub, if you guys are familiar with that, which is like a pirated hub of all of the academic papers, very popular among PhDs, very unpopular among Elsevier and organizations like that. Those are the kinds of things, where they're, in a somewhat of a gray area where these decentralized cloud services will really, find their own. Go forward one slide. If you want to see what we're doing, I only touched on it, but we're doing a competitor to LinkedIn. You can see what we're up to. And if there's any questions, you can email me at balaji@earn.com on the last slide. And Santosh, maybe you have a couple of questions. I can take them very quickly, and then I unfortunately need to head out.
No problem. Just a few, just kind of expanding the conversation here. You're on record saying that by 2025, 2030, almost every asset will be tokenized. Just elaborate, what will it look like? Practical sense, could you elaborate on that?
Sure. So if you go to Google Images right now and you type in, I don't know, blade of grass or whatever, you're going to see tens of thousands of images of blades of grass, right? Anything you can think of, someone has photographed it. And that was sort of unthinkable in the early 90s. Like you could just instantly get, if you want pigs flying, you can get an image of that, right? Information on anything you could possibly type in a search query for the most part, you can find it. I think the same thing is going to be true for financial instruments. Anything you could imagine trading, anything that has any scarcity whatsoever, there will be a search engine-like interface where you can type in what that is, and then you can see 500 different instruments to trade on that. It's like pork bellies and orange rinds or whatever, orange futures, but to the nth power. You'll be able to speculate on for example, the price of storing 1 megabyte on 1,000 remote computers, or the price of 1 minute of time from 10,000 people in Seattle, or any kind of bet or derivative of derivative that you can imagine is going to be tokenized, and it's going to be freely tradable over the internet. Basically, the way I put it is the internet is about to become the world's largest stock market. Another way of thinking about that is the number of public stocks has been declining. The number of tokens is about to pass the number of public stocks. Obviously, the total market capitalization of tokens is much less than the total market capitalization of the stock market, but it's not like 10,000, x less. It's like 100x less, and that's going to grow fast. And I think by 2025 or 2030, that may pass.
Sure. And so, in terms of overall, so 2025, 2030 is still your time frame. How soon do you think all this?
Yeah, I mean, I think 8 years to 15 years is a long time in technology. I mean, think about what Google was in 2000 versus what it was in 2008 or 2015, right? And the thing about the blockchain was in 2009 versus what it is now. I think it's going to become absolutely ubiquitous, and there's not going to be a piece of Wall Street that isn't affected by it. The very smartest, institutions on Wall Street will be like, where the Wall Street Journal or the NYT are, and have adapted somewhat to technology. But I think the best institutions those are going to be started from scratch as blockchain-first institutions. With that, Santosh, thank you very much. I can take further questions by email. Unfortunately, guys, we've got a very tight schedule today, so I'm going to jump. But thank you very much.
Okay, great. Thank you. I think we'll go next to Martin. We'll pick it up and get an overview on the whole space. Starting from the long time back, from the traditional economist point of view, coming down to today's blockchain world. So take it away, Martin.
All right, good afternoon. I'm Martin Hutchinson. And next slide, please. I'm going to talk about winners and losers in 2018, but first take a look at how this market's developed and what it looks like in terms of other embryonic markets. And so next slide, please. I'm going to start by looking at the South Sea bubble, which was a 1720 stock market boom when stocks were brand new, and I think has substantial analogies to the cryptocurrency space. I'm then going to look at sources of long-term value for cryptocurrencies. I'm going to look at the dangers, which seem to be regulation, fraud, and volatility. I'm going to take a punt at looking at where Bitcoin's going in 2018 and beyond. I'm going to talk a little about selecting and trading cryptos if you're actually a small-scale investor in them. And then I'm going to look at the market evolution in 2018. I think this is a bubble. How big will it get? How long will it take? What happens after it bursts? And then finally, I'll wrap it up with some thoughts on where the space is going. Next slide, please. The South Sea bubble in 1720, stocks were a completely new instrument. They were utterly analyzable because, for one thing, nobody produced public accounts, and so you'd no idea what you were analyzing. And yet they had real value. So I think they're a very good analogy to the crypto market, a much better one than either Dutch tulip bulbs, which seem to me to have had no information about them at all, or alternatively something like the dot-com boom of the 90s, which was altogether too well organized and too well within the conventional system. The South Sea bubble was a gigantic stock market bubble. It was about 1.7 times British GDP at its peak. So that's the equivalent of 30 trillion today. There are no rules of thumb for trading and valuation, partly because they hadn't invented them, and partly because they had nothing to measure. There wasn't much leverage, which is interesting. It was mostly equity, and that's unlike the contemporary French Mississippi scheme, which ran about a year earlier than the South Sea bubble and resulted in the French middle classes being devastated when it crashed, because that was all around the bank, and when the bank went bust, everybody lost their savings. And that's one reason why France was a mess in the 18th century and couldn't stand up to British aggression and the constant wars that we had. Companies didn't present accounts, and there were no valuation techniques anyway other than yield. And the legal structure was very undeveloped. You had to get an act of parliament to start a company. Next page, please. There was one big player, the South Sea Company, and numerous satellites. And the big player got fed up with having all those satellites, and so lobbied Parliament to get a Bubble Act passed, which basically stopped you forming new companies. And that closed down the satellites. It also stopped new companies forming almost completely until 1826, when it was repealed. There were innumerable scams. One of them was a project of great moment to be announced later. There was also Puckle's machine gun, which fired round bullets at Christians and square bullets at Turks. That's an example of great technological advance, but I don't think they quite had the engineering capability for it. But there were also some worthwhile companies. There were two assurance companies, the Royal Assurance and the London Assurance, which had a monopoly of the marine assurance business until the 1820s, and survived, in fact, until the late 1960s when they were taken over. They didn't go bust. And the South Sea Company itself didn't have any debt, and so basically its stock price ended up about where it had started. It went from 100 up to 1,000 and back to 100 again. And then it survived until 1853 as an income stock. The core companies, the ones that were solid, did not go bankrupt. Wealth was redistributed, but it was preserved. Next slide. Sources of long-term value for cryptocurrencies. There are a lot, and I'm just going to go through a few of them. One is anonymity, which we haven't mentioned. This is the principal libertarian argument for cryptocurrencies, is the U.S. Foreign Account Tax Compliance Act of 2010 broke Swiss bank account secrecy. And that means if you don't entirely trust your government, you've got nowhere safe to put your money. And cryptocurrencies have emerged as an alternative store of value for people who are nervous about their governments. And it's not just for crooks and drug dealers, it's for anybody who doesn't entirely trust their government. And having grown up in a country with a 98% income tax rate, I can say that such distrust is reasonable. There are only few cryptos that are fully anonymous. Bitcoin isn't. And quantum computing within the next decade may break full anonymity, but then with a bit of luck, you'll have quantum computing cryptos that will restore it. So the anonymity will probably last as a long-term feature one way or another. While it lasts, anonymity has great value. But you do need, if you're going to use it as a store of value, to find a way to reduce crypto price volatility. And then they become a very good store of value. Next slide, please. A second source of value for cryptos is as a payment system. Blockchain's recognized as a significant innovation in the payment space, and various of the big banks, JP Morgan and so on, are looking at adapting it to terrestrial payments, if you like, but also the cryptocurrencies themselves can facilitate better money transfer. For example, there's Omisgo, which is based in Southeast Asia, which finances money transfer in a location where there's lots of small currencies. You've got the Singapore dollar, the Malay dollar, the Thai baht, the Philippine peso, and so on. And Omisgo can act as a common denominator for those. Other cryptos facilitate cash to crypto interchanges. Monaco and Stack, for example. Stack has an arrangement with MasterCard, so you're going to be able to buy things directly. They did an ICO recently. And then there are a few cryptos that assist communication between different types of blockchains, which is a problem because everybody's setting up their own. One called BlockNet and another called Arc that act as interfaces between blockchains. Next slide, please. Another source of long-term value is decentralization. There are several coins funding software projects to create a decentralized internet, and they're then used as payment for internet services, whether it's bandwidth, storage, or processing. And mining takes place not just by using electricity, but by providing services. And those look to me to be a stable base for substantial businesses. One is Filecoin, which did its ICO last August. There's another called MadeSafe Coin, which is based out of Troon, Scotland, which has been around 2 or 3 years and has its software pretty well developed. Then there's an alternative use for them, which is decentralized hardware resources, where coins are aiming to take on the cloud providers like Amazon and Microsoft Asia, and coins are used as payment for computing resources. And examples of that are Golem in Poland and then CR Coin. Next slide, please. Another source of long-term value is the several extra ones. Communication, internal communication. Steam facilitates a crypto-incentivized social network, and that one's been doing very well in the last few months. Then there's many cryptos led by Ethereum that facilitate smart contracts, which basically enable you to do decentralized digital contracts, and that's a big area of effort. And then there are marketplaces. BitBay and Syscoin are looking to create decentralized marketplaces for physical goods. Next slide, please. The dangers in the crypto world look to me to come from 3 places: regulation, fraud, and volatility. Next slide, please. Regulation, different jurisdictions take different views. You've got the favorable view, which is taken by Switzerland, Gibraltar, the Isle of Man, and Mauritius. Then you've got the people who are trying to ban ICOs. So far, China, South Korea, Russia, and Vietnam. Not necessarily successfully, but they're trying. By and large, offshore banking havens like cryptos because they're a return to traditional anonymity of the Swiss bank account. And the US is somewhere on the fence in this particular case. The big problem, of course, for the regulators is cryptos with true anonymity, such as Monero and Komodo. These pose a problem of money laundering, but they're a good store of value, and they could be attacked by the swamp and be driven out of the US. I don't believe the official Trump administration is likely to try and kill this market, but a rogue regulator certainly could, and indeed an international agreement between rogue regulators, an international swamp, if you like, could kill their value. And this is one of the big dangers over cryptos as a whole. And the regulatory overhang is an existential threat to cryptocurrencies, but it's a fairly low probability one. Next slide, please. Fraud is a big problem. It can be carried out by the coins themselves, doing ICOs for rubbish, or by third-party bad guys. A few recent examples. The BitConnect problems are part fraud, part regulation. The BitConnect exchange was not registered in North Carolina or Texas, which is where it was located. And the interest on BitConnect tokens may have been a Ponzi scheme. It's not quite clear. Many ICOs themselves are partly or completely fraudulent. They rely on an investor enthusiasm for all things crypto. For example, the Telegram ICO, which is an instant messaging company, it's a $1.2 billion ICO, which is gigantic. It's Russian-backed, not the government, but Russians, and looks to me very 1720-ish. They actually announced in the FT, making profits will never be an end goal. Well, if you're trying to raise 1.2 billion, it bloody well should be. Third-party baddies last week stole 500 million in NEM tokens on the CoinCheck exchange. This is a Japanese crypto. The problem follows the Mt. Gox scandal in 2014 and several other instances. Crypto and exchange security, particularly security of the exchanges, is often second-rate and therefore hackable. Fraud's a much bigger problem than with today's stocks. It's much more like stocks in 1720 or indeed the Wild West. Then volatility is not so much an existential threat as a problem that needs to be solved. Cryptos must become less volatile to become serious sources of value. One way to become an effective payment mechanism is to become less volatile. The South Sea Company became stable after the bubble burst. It started paying a regular dividend and was an income stock for 133 years, and the price didn't vary more than 30% up or down around par. And question as to whether this will happen to cryptos after the inevitable crash of the first bubble. There were some pretty substantial forces for long-term stability. Institutional investors trading will give us greater market depth. Futures markets and the largest cryptos will give us hedging and therefore will also increase stability. Also, the margin requirements for futures trading will be huge until they become more stable. And so there'll be a massive incentive to futures traders, players in that market, to make the cryptos they're trading more stable in order to reduce the margin requirements. Our concentration of the market on the largest cryptos, I think that there will probably be somewhere like 8 or 10 cryptos in 5 years' time that have 95 to 98% of the market capitalization. And once we get to that will produce greater price stability. Mutual funds of one sort or another will become substantial investors, and they will want stability. And eventually, the flows of real economic transactions will dominate. And stability is in the interests of all serious participants, except for speculators, and will therefore happen. Next slide, please. Talking now about Bitcoin 2018 and beyond, there were two reasons for January's price pullback. One was a natural evolution from Bitcoin away towards other better designed coins, and the second was the worries about the Bitfinex and Tether connection. And the good news for Bitcoin is that its Lightning network speeds Bitcoin's payments. You don't have a 10-minute delay anymore. It removes the obstacle to its wider adoption, but it is not really fully decentralized, which is a problem. You have to trust the people that are running Bitcoin, which is always tricky. Bitcoin lacks full anonymity, and that makes it attractive to governments who will tend to boost it, as against the Moneros and Komodos of this world. There's also a CFTC investigation on Bitfinex and Tether, which casts a cloud on it. Bitfinex is the leading Bitcoin exchange. The Tether coin is controlled by it and linked to the dollar. Its price is always within a cent or two of a dollar. And Tether is supposed to be backed entirely by dollars, like the gold standard, but in fact, we think may be being backed by Bitcoin. And if Bitcoin is being bought to back Tether, then that provides an artificial boost to Bitcoin prices, and that's the same dodge the South Sea Company used in 1720, so it's not good news. My belief is that Bitcoin's market share will decline over time, though it will remain one of the leaders.
Hey Martin, it's Brad here. So we're running a little long on this, so if we could just power through these, just want to leave appropriate amount of time for David and open up for some questions just to management on time.
Yep. Sure, okay.
Thank you.
Well, selecting cryptos quickly, you want good tech teams, software completed or close to completion, solid value raison d'etre, and a clear means of mining new tokens and limit on their creation. The winners will be anonymous, top quality code, meaningful projects and achievements. The losers will be hack vulnerable, hype ahead of reality, of which is a lot, no solid value added. Trading cryptos, you want to be a momentum investor, not a value investor, because value is impossible to determine, whereas momentum increases the salience of the coin. Market timing's key, and you want to set limits on trades because the markets can move fast. Next slide. There's the past and future development of the crypto market capitalization. If you take last 4 years rate of growth, you've got 3.8 trillion at the end of 2018, which is a reasonable estimate of where we'll be. Next slide. How big will it get? I'll give you some size markers. Gold has an 8 trillion market cap. US M1 money supply is 3.8 trillion, which is 20% of US GDP. The dot-com bubble was 4 trillion. South Sea Company at its peak was 200 million pounds, which is either 40 billion if you scale by prices or 30 trillion if you scale by GDP. So a lower bound of the peak might be the value as a means of payment, which would be, say, 5% of world GDP times the 20% money supply to GDP ratio, which would be 800 billion. Upper bound, I think, somewhere between M1 and gold, so 4 to 8 trillion. Anything a bit bigger will be a very short spike. And if we're forecasting a market cap of 3.8 trillion at the end of this year, then the crash should be sometime in the next 18 months. But that's not the end any more than it was in 1720. Next slide, please. After the bubble bursts, cryptos are unleveraged like dot-coms or the South Sea Company, but not like subprime home mortgages or the French Mississippi Company, contemporary of the South Sea Company. Hence, the crypto crash will be fairly economically harmless, and failed cryptos will normally fade away, not implode. Fully anonymous cryptos have a major place as a store of value. They need volatility comparable with terrestrial currencies, and there's a reputation risk if they become too much used by drugs and the mafia. Some cryptos will become alternative means of exchange, such as Omisgo, substantial continuing role in the payments business. Crypto ICOs are a long-term funding source for tech projects. I agree with Balaji that they're going to be a major player. I don't think they'll be the only player. They're decentralized, less bureaucratic fundraising mechanism than a US public offering. And they're also independent of the constraining short-term oriented San Francisco venture capital network. And some cryptos like Steam may prosper providing services to the crypto world. So conclusion, of course it's a speculative bubble. It'll burst probably late 2018, early 2019. Everybody will in the short term lose 80-90% of their money. Volatility needs to fall for the full potential to be achieved. However, there is round about an 80% chance, maybe somewhat more, maybe as high as 90, that there's a long-term market after the bubble bursts. And the other chance, 20% or maybe as low as 10, is that either regulation or fraud will kill the market. And you have to bear that risk in mind when you're investing. It's a lousy store of value until volatility is damped. There's a problem as a means of exchange. The guy who bought a pizza with them in 2010 had huge buyer's remorse, so you've got to remove the volatility for that too. Blockchain has a modest but not gigantic long-term role in payments. Yes, it's a new asset class, has real long-term value independent of other asset classes if you're an investor, and it's a potentially new libertarian form of money. Thank you very much.
Thank you, Martin. That was a great lay of the land. I think that leads us very well into David's presentation. So we'll take it there.
And David, can you just say something, make sure we can hear your voice?
Yeah, can you hear me?
Yeah, great. You're loud and clear. And just quickly before David jumps on, there's a fair amount of people here. We've had a lot of questions coming through. Please send some now. We're going to choose, 5 or 6 post call. So David, take it away, and thanks for your patience. For
sure. And thanks, Martin, for the great presentation. So let's get on with the first slide. This one. So the topic of this call is essentially beyond the blockchain and why we had to create IOTA, which is a protocol that goes beyond the blockchain. So I will touch very briefly upon what we are, who we are, and why we are here today. So we, all of the founders of the IOTA Foundation and the IOTA project, we started in the blockchain space in 2011. I started full-time in 2012 together with the rest of my co-founders, and we created a lot of the pioneering work like in identity, voting, decentralized exchanges, decentralized marketplaces, etc. In 2013 and 2014. In 2013, we also invented the first full proof of stake blockchain. So we did a lot of like experimental work on blockchain, and we've dabbled in pretty much all of the different vectors that Balaji also dipped into in his presentation. We set up a non-profit foundation in Germany, which at the time was considered quite insane because Germany is quite strict on regulation and it's not an easy place to get set up. But we did it because we wanted to separate IOTA from the rest of the fold, so to speak. We did not want to go to Switzerland. We did not want to go to Singapore, Cayman Island, Isle of Man, these kinds of easy places to set up. Instead, we want the onerous oversight and we want to be in with the real industry because we believe that the crypto space is filled with too much fraud, too much bullshit, too much hype, and we did not want to partake in that. So the structure we have now is that we focus on building a very strong team. We have 60 plus full-time employees that are developers and researchers mainly. Then we have some world-leading advisors like the Chief Digital Officer of Volkswagen Group and partner at Bosch Venture Arm, etc. So then we can go to the next slide and get into the meat of the issues with blockchain. So there are 3 problems that I will explain here and also explain how IOTA resolves them. So the first one is centralization. Go one back first, so I can just quickly go over. So the first is centralization. So even though blockchain is always touted as like the epitome of decentralization and it frees us from the powers that be, that is not reality, and I will show you why later. And the other is the scaling limitations, which we have all experienced in the last couple of years when blockchain has really become a mainstream speculative asset. And the crypto kittens that was mentioned was a very good example of that. It crippled the entire Ethereum network. And these were just stupid digital, smart contracts with kittens in them. And that was enough to close down the entire Ethereum network essentially. And the third part is high fees. This is also something that the people that recall blockchain from 2014, 15, 16 remember that it was always advertised as blockchain has low fees. But as I will show you, that is not the case, and it will only get worse. So next slide. So of course, the topic is blockchain versus Tangle. So Tangle is the equivalent of blockchain in the sense that the Tangle is the backbone. It's the distributed ledger of IOTA, just like blockchain is the distributed ledger of Bitcoin and Ethereum. So essentially, all blockchains are distributed ledgers, but not all distributed ledgers are blockchains. As in the IOTA case, we are using a Tangle. On a technical level, that is a directed acyclic graph. Tangle is a special incarnation of it. And I will show you the differences and how they resolve the problems that I have just posited. So we can go to the next slide. The first thing that really comes to mind is the fees of blockchain. So this comes about from the blockchain bottleneck. This is inherent to the architecture of blockchain, and it's not something that is going to get fixed by a patch or some tweaking. And the reason for this is the fact that you have a sequential chain of block after block after block, a very artificial and very rigid structure. And in each of these blocks, you can fit a certain amount of transactions. So you have a certain amount of supply. But as we can see under high volume hours, the demand outpaces the supply. And then, of course, as a validator, you only choose the transactions that include the highest fees because you are only in this game to make money. And that also highlights this issue of decentralization issue, that in blockchain, you have essentially two parties. You have the users, then you have the validators / miners. And those miners and validators and users have completely diametrically opposed incentives. So that's the first problem, that blockchain will always have this issue with very high transaction fees. And I think it peaked at like $44 or something to send a Bitcoin transaction. And I mean, good luck using that for anything in the real world. Perhaps except for moving like $1 billion, and you may not care about $44, but for most other transactions, you will. So then we can go to the next slide, which I think kind of visualizes this a little bit better. Here, of course, on the left side, all of the gray blocks, they are the blocks that are kind of waiting to be confirmed. But as you can see, because we have this very artificial and stringent block after block after block after block architecture, it is like the epitome of a bottleneck that we're seeing. We're seeing the demand grow and grow on the left side, and the supply will always remain the same in the middle. So then we can go to the next slide. And then, yeah, that kind of touches upon the scaling issue. And now we can see how the Tangle already right now differentiates itself from the blockchain architecture. Unlike the blockchain architecture that is very, like I said, block after block after block, here you have a tangle, and that's why we call it a tangle, because these transactions are tangled with each other. On the right side, what you're seeing is what we call tips. These are the most recent transactions that have been issued into the network. And as you can see, all of them have these two arrows kind of traversing the rest of the tangle. And what that represents is which two transactions they are validating. So every time you issue a transaction in IOTA, you're also validating two previous transactions, which again validates their own two respective transactions, and so on and so on and so on, until the entire network converges on consensus of this transaction is finalized. And the thing I really want to highlight here is the fact that this is the complete opposite of blockchain, in the sense that it means that the more transactions that are being issued, the faster the network actually becomes. And you can see the bottleneck is kind of being stretched out as a result. In fact, in retrospect, I should have made this illustration convex instead of concave, just to illustrate that point further. But this gets hopefully some of the point across. So we can go to the next one, which shows, yeah, I will just very briefly go through how consensus is reached in IOTA. So like I said, when you issue a transaction, you are a user, but you're also a validator. So we have completely removed the decoupling, which is in the case of blockchain where you have the user and the validator. And instead, we've made them one and the same. And so validation has become an intrinsic property of using the network. And how that happens is that when you issue a transaction, you run this thing called the tip selection algorithm, which technically it's a Markov chain Monte Carlo random walk algorithm, which is just fancy speak for you're being given two random transactions that you are to validate, which again have validated their own two respective random transactions. Then you sign with a private key, just like you do in any other system. Then you carry out a small / negligible amount of proof of work. And this is much more similar to Hashcash than Bitcoin. It has nothing to do with kind of the validation that is occurring in Bitcoin or Ethereum or any of the other proof of stake blockchains. It's only there as a spam and Sybil resistance. So it's not 100% free forever if you were to spam infinite transactions. So yeah, I think we can go to the next slide, which then kind of highlights already the first problem that I mentioned, which are the fees. In Bitcoin, because you have the miner as an intermediary party, you just, instead of having Visa, PayPal or whatever, now you instead have the miners in China. So you have to pay them. You have to literally pay them to validate your transaction. In IOTA, that is not the case at all. Every single user is an equal validator, meaning that there is no mining, and that also means that there is absolutely no fees. So if I send you 0.0001 cent, you will receive the exact quantity. Nothing gets lost in the transaction process. So then we can go to the next slide. This again illustrates what I mentioned regarding scaling. Blockchain works quite good in the beginning when there is a very small network and the demand is small, because that means it fit the supply and there is no kind of there is no friction there. But as soon as it scales, as soon as you actually get adoption, which is the entire goal, it completely degrades in usability, as we've seen with day-long congestion issues and insane fees. Whereas in IOTA, with the Tangle gets more and more efficient the more people use it. So in Tangle, there is no theoretical limit to how many transactions per second can go through the network. So in Bitcoin, you have 5 transactions. In IOTA, with only just like 120 nodes, you can already do way past 550 transactions per second. So if you scale that up, of course, you start talking about hundreds of thousands of transactions per second in the network, completely decentralized. Of course, at the end of the day, you run into the bandwidth limitations, i.e. the speed of light. You can never beat laws of physics. But other than that, there is no limitation to how much Tangle can scale from a technical point of view. So then we go to the last kind of the third or the 3 problems that I listed, and that is blockchain centralization. And like I said, blockchain has always been like the hallmark of decentralization. This is the most decentralized system in the world, but the fact is that's complete bogus, because first of all, you have miners which have a lot of resources. They invest into mining gear, which is the reason there's a GPU shortage all across the globe. And those mining farms again congregate and aggregate into these mining pools. So at the moment, the Ethereum network is controlled by 4 mining pools. The Bitcoin network is controlled by 3 mining pools. In 2015, there was a mining pool that had 51% of the power in Bitcoin. So essentially, they could have disrupted the entire blockchain. And this will always, like, this is just an inherent problem in blockchain. It will not be resolved. And the reason for that is simply because as you accumulate more resources from your mining, you reinvest that, and that means you get even better returns. And so it is this race to the top, essentially. Then we can go to the next slide. In Tangle, like I explained, because you as a user is also the validator and every single user is an equal validator, there is absolutely no incentive to centralize anything. There are no fees to collect. There are no block rewards to collect. There is no incentive whatsoever for any of the consensus resources to congregate. So instead, it's a completely democratized network and completely decentralized. I would say the maximally decentralized model that you can get out of a distributed ledger. If I remember correctly, that is kind of the last of the tech side of IOTA. Now I will just briefly go through some of the use cases. So IOTA was essentially born in 2019 at the end, 2014, at the end of 2014, when we were contemplating distributed systems like distributed computing, these computational resources, storage resources, bandwidth resources, some of the things that Martin mentioned. And we call this the economy of things, or the machine economy. So let's go to the next slide and we can visualize some of these use cases. So of course that means anything can essentially be commoditized, just like Balaji said, that you can sell your bandwidth, you can sell your computational power, you can sell your drone footage in real time, you can sell your weather data or electricity, whatever it may be. Any kind of thing can sell itself. Data can sell itself, and that of course creates kind of this Cambrian explosion of technological innovation. So then we can go over some examples that we're doing. This again just reiterates the importance that most of these transactions are very small. If I'm purchasing some data today from a sensor, I might only want to pay $0.01 for it, tops, because it's just like one packet of data. But of course, if you have billions or trillions of them, that becomes a huge economy. And then it's very, very, very pivotal that there are no transaction fees. So it's just important that that's kind of what this slide is meant to represent, that you get the full amount, and that creates exactly this permissionless ecosystem where all of these different devices and these different actors are trading constantly with each other on demand in real time. There are no fees, so there are no intervals. Instead, you're paying for the exact quantity of what you're using. If you're charging your vehicle, you're paying per watt. You're not paying up front. You're not paying for a subscription. You're paying in real time as you use it. And same thing goes for, of course, kind of the sharing economy 3.0. That is a big buzzword today. And of course, when you can pay in real time on demand without intermediaries, you can essentially lease anything that has a chip in it. So you can imagine your drone, your car, your bicycle, your tools, appliances, whatever. If you think about it from an ownership perspective, philosophically, it's sitting there 98% of the time idle. You're not using your car more than like 2-3% of the time. Same goes for pretty much all of your belongings. So why shouldn't you rent it out in real time and make money of it? And these are the things that will be assetized later, as Balaji also mentioned, that everything can essentially be assetized. And again, microtransactions become key there. And this also will give rise to kind of these autonomous economic agents. So here we have the example of a car that essentially is able to pay for itself in parking, in charging, in toll stations, and hopefully we can get rid of toll stations and instead pay for the exact amount of time you use the road instead of just haphazardly where you are geographically located. And it can do predictive maintenance and order those things, etc., etc. Essentially, the car becomes its own identity. It's no longer like you own it and you lease it out. Instead, it's just a fleet management thing. You can imagine fleets of cars, and that's kind of the direction that Tesla and Uber is going. Then we can go to the next slide, which shows some of the things that we are doing right now. We're working with Volkswagen Energy and BigchainDB on securing data within the car itself. Again, a very important thing. And one of the unique things about IOTA, because of no fees, no scaling limitations, you can also use it as a data transaction. I mean data transmission protocol, because you have the data integrity ensured. As soon as you put hash of the data or the data itself into the ledger, it can never be changed again. It's immutable, meaning that if your car is using this kind of system, there is no way for a hacker to go in there and change some parameters. You suddenly can't use the brake, or you're reading the speedometer incorrectly or something. The data is secure. So that's something we're doing with these companies. And then we can go to the next one. This is one of the biggest utility providers in the Netherlands. They built, I think, 1,300 of these chargers for this project that we have called Oslo to Rome, where we go from here in Oslo all the way down to Rome, and all of the electrical vehicles are only being charged via these chargers and paying in real time with IOTAs. And that's another real world use case that is being deployed. And this is kind of, again, one of the last things I want to emphasize is the fact that all of the blockchains can in principle enforce data immutability, but because of the fees, because of the scalability limitations, you simply cannot use regular blockchain for data. It's too expensive. If you were to do this, even Google would go bankrupt by the end of the day because it's so much data. And if you had to pay, I don't know what the Bitcoin fee is today, let's say $5. If you had to pay $5 per packet, yeah, good luck. No company in the world could sustain that. But in IOTA, every time you issue a data transmission, it acts just like a transaction. It validates your previous transaction. It makes the network faster and more secure, and it's completely free. And this is something that Bosch is using right now with their new Bosch XDK, which is one of their really fancy and advanced sensors. So essentially, you sign the data onto the ledger at the sensor, and then when the data is being transmitted to the cloud for analytics, the cloud can essentially check, does this match what was put into the ledger directly from the sensor itself? And you can do kind of this pair comparison and ensure that there has been no man in the middle attack, no tampering of the data. So yeah, that's another one. And then I think this is the final one, final example. We launched this as a pilot study, the data marketplace. And the idea is, again, to open up these data silos. So today, 99% of data gets lost forever to the void. It's never acted upon. It's never being used. And a big reason for this is the fact that the companies have no reason or way to actually share data in a monetizable way in real time. But this is exactly what IOTA enables. And then if we go to the last slide, this one, you can see some of the participants that are part of this. So of course we have Philips, we have Samsung Arctic, we have Deutsche Telekom, and a lot of these very, very big companies with a lot of sensors. Bosch, of course, I think they have the most sensors in the world actually. And all of them are now kind of exploring this data marketplace that is using IOTA for securing the data and also paying for the data in IOTA tokens. So yeah, that's my presentation.
Thank you, David.
Thank you, David. That was a great presentation. I think we have time for just 2 questions, maybe one each. For you, David, just looking at the pros and cons here of IOTA vis-a-vis blockchain, looks like an absolute winner. Why would you think this will become the de facto standard going forward? When do you think it'll become more popular than blockchain, more used than blockchain?
Yeah, for sure. So it's important to just realize that Bitcoin itself was built upon a lot of previous concepts. So when Satoshi Nakamoto put it together, he put different pieces like from BitTorrent, from Hashcash, etc., together and created what I would say is a prototype. And usually prototypes are very rigid in design, and that's what we're seeing with this very sequential block after block after block thing. And that's why we haven't seen these kinds of technological innovations happen until later on, like we always see. But yes, I do believe that the Tangle and IOTA, that it will overtake a large portion of it. And we are taking a very pragmatic approach to it. We're not touting any ideology. The foundation is completely non-profit, completely open source, completely free of any bias. And therefore, companies are coming to us daily, like huge companies coming to us daily, saying they've experimented with Ethereum and they like the principles behind the distributed ledger, but blockchain simply cannot scale for their production-ready environments, and the fees are simply too high, so therefore they're interested in IOTA. So indeed, the goal of IOTA is to make it one of the like de facto distributed ledgers that is completely permissionless.
Great.
Just like TCP protocol, essentially. Yeah.
Yep.
Great. And David, this is another question coming from the audience regarding IOTA specifically. So we'll direct it to you, and then I think we have one for Martin after this, respecting that we're coming up on a little over an hour here. So, and I think this is a good question. There's a bunch in here. What is the incentive for validators to participate in IOTA if there is no direct compensation for their work and their time?
Yeah, perfect. Good question. Perfect question. So the beauty of IOTA is the fact that you as a user, your entire incentive is the fact that you get to use the network. So it's kind of this intrinsic property that when you're using the network, you're also validating, and every other participant is doing the same thing. So the only cost to you in order to use the network is to carry out this validation, and this validation doesn't cost anything in terms of electrical consumption, like not beyond, of course, the thermal limits of the laws of thermodynamics, of course. But it's not like it would be, if you calculated it, it would be like 0.0000001 cent or something per transaction, which is not even like it costs you more to move your hand to push send in calories than it costs for your electrical hardware to actually carry out that transaction. So the incentive is simply to be able to use the network. It's a very, in my opinion, very beautiful system because it makes utility becomes the inherent property of the network.
Got it.
Sure.
Thanks.
Sure. Martin, just one question for you. Just looking at your presentation, since you come from a very traditional background and you're an economist, you think the regulation headwind is not going to be that strong? It won't really stop anything. So what makes you think that? I mean, there's strong regulation. India just banned the exchanges and trading. China is strong. So what makes you think that the regulatory headwind is going to be small or short?
I think there's a small probability that the regulatory headwind will be definitive and stop it happening. And that probability is basically if all the world's governments, or essentially all the world's governments, get together and do something through the G20, for example. But individual countries banning them just pushes it offshore. So I don't think that slows it down all that much. And I think that the incentives from things like IOTA, all the various things that are going on, is all in favor of allowing this to happen. I think it would be very unpopular to ban it, and as it grows, it will become exponentially more unpopular to ban it. So even though I think if we had a very highly regulatory system in the US, it might try to shut it down, I think every month that passes makes it less likely and reduces that 20% probability to a 10 or a 5 or a 0. The only thing is if there's a really huge fraud, that will, of course, cause demand for regulation. And then the combination of fraud and regulators being nervous could shut us down. But I think that's fairly unlikely, fingers crossed.
Great. And I think another question to piggyback on that, and then I think we're going to have to move to closing remarks.
But by the way, can I just add right
Sure.
before to his thought, because I completely agree with everything Martin just said there, and I just want to say that the IOTA Foundation, we're talking with governments, we are making sure that like we're kind of driving the conversation rather than having people that have no clue about what they're actually regulating, that they actually have that. We have a legal researcher and legal advisor to the G20. We will be participating through that process for the upcoming meeting in March. So I think that I completely agree with Martin. I don't think that the regulation will hamper the growth. There will come some regulation, which is good to get rid of all of these bullshit ICOs. Not all of, but most of them. But the point is, I do believe, just like Martin stated, that for every month that passes, and as long as we see more and more serious projects, then indeed there is very low probability that regulations can shut this train off.
Great. I think we have to close the Q&A session. What I'll do is, if you don't mind, David and Martin, I'll just collect all the questions. We have tons of questions, very interesting questions, very relevant questions. So we'll pass it down to you. So if you have some time, it'll be great if you can answer them, and we'll forward it to the questions. Great. So let me do a closing comments here. Thank you all for the participation here at Manhattan Venture Research. We, like Jared said in the beginning, we do cutting edge research on private companies. We try to be the thought leaders and it's a very opaque market, and we try to be upfront with new ideas. So I recommend you sign up, you register on our website. We have tons of information out there. We have initiation reports, and we also have a monthly insight piece called Venture Bites that kind of keeps you in touch with the private markets and gives you ideas for private market investments. So with that, I just want to close the session. Thank you again for the participation.
Yes, and last but not least, this webinar has been recorded and will be available. So shoot us a note if you like it. For all those that missed it, they will have the chance to view it later. Again, from everyone at MVP and Manhattan Venture Research as well, we appreciate your time, attention. David, Martin, you were fantastic. I know a lot of people are looking forward to this. Very topical and timely, and we appreciate it.
Thank you.
Yeah, thanks.
Bye-bye.
Thank you.
Bye.